E-mini S&Ps end the week heading lower, trading down below 4,400, actually seeing the lowest weekly settle since October of last year. A lot of things going on in the market here as we continue to see stocks. They moved up, they moved down even more. We're seeing a lot of rising risks geopolitically. We're seeing them via central bank risk. We're seeing them via economic risk. And a lot of uncertainty rising, kind of making that risk off trade, adding to the momentum of that risk off trade, I should say. We're seeing a flight to quality bid in the bond market. We saw yields coming down to their lowest in a week across the hall there. And ultimately, at this point, the market is going to wait and watch. Ahead of a weekend when there's especially a U.S. holiday weekend, there's a little extra time in there when things can happen when you can't address your portfolio. And clearly today we saw a lot of put buying, so put skews are very rich. That obviously pushed volatility higher. We'll talk about that in a moment. But ultimately, all the protection and all the expectations heading into the weekend were looking at the downside. And that's exactly what they saw. Equities moving lower again, settling on their lowest on a weekly basis since October of 2021. And what does this all mean for volatility? Well, VIX index had been moving higher as equity indexes move lower. We talked about that before, but this week we saw it get just under 30 on Friday as equity markets continued to push lower heading into the weekend. So we did see a move higher, second consecutive week we've seen a move higher in the VIX index, but it wasn't screaming higher. And at this point, we'll have to wait and watch. Volatility has been slowly and steadily rising in equities for quite some time as equity indices, continue to trade back and forth and ultimately pushing lower to end the week here today. Now, lastly, what do we have next week? Anything that could possibly change the trend that we're seeing, higher volatility and lower indices? Well, we do get a lot more earnings coming out that'll continue to kind of feed the market. Likewise, we get the PCE data, which is one of the Fed's favorite inflation gauges. Yes, inflation will be read in those numbers, I'm sure, as well, as we've seen in PPI, CPI, and others. Lastly, we do get a slew of Fed speakers, and two of the names that may be absent from that list are one, St. Louis Fed President Bullard, who has been on the tapes over the last week and a half causing a bit of a ruckus with his rates should be at 100 basis points by July mention about a week and a half ago, and then he doubled down on that this week, confirming that he didn't misspeak and that he does see the need for a faster, more aggressive Fed. Likewise, we don't get to hear from Mr. Powell, which typically when we see the markets moving around and there's a lot of uncertainty, expectations between a 50 and 25 basis point hike at March FOMC have been all over the map. So at this point, you may expect to hear from the Fed chair prior to the blackout period that will cover the March FOMC meeting itself. So he is not scheduled to speak next week either. Today, though, we did get New York Fed President Williams talking. He kind of took the other side of that Bullard argument, saying that, yes, while it is necessary for the Fed to begin raising rates at March FOMC, he didn't see the need to be more aggressive, and we saw those expectations for a higher rate hike, come way down. So we saw 50 basis point rate hike expectations north of 80% over the last week and a half. Today they were down back below 25%. So again, the market is all over the map. Doesn't necessarily mean where we begin and where we end. It's the fact that we keep seeing these spikes higher in news, spikes higher in risks, and we see the equity markets selling off on those types of announcements. That's exactly what we saw today. So ending the week at our lowest weekly settle. We did not exceed the last week of January lows, but we did exceed it on a weekly basis. The lowest weekly settlement we've seen in E-mini S&Ps going all the way back to October, with all eyes focusing on that March FOMC, despite the fact that it is still February. That's the next big moment in the equity markets down the way.